Imagine waking up one morning and genuinely realizing, that you never have to work again if you don't want to. Not because you won the lottery, not because you inherited money, but because the investments you build over time are now generating enough income to cover your life indefinitely without ever running out. That number you'd need to hit? There's actually a precise, research-backed formula for calculating it, and almost nobody outside of niche financial circles knows it exists. It's called the 4% rule. And by the end of this video, you're going to know exactly what it is, where it comes from, whether it actually holds up, and most importantly, what your personal number is to reach financial independence. My name is John, and I spend way too much time thinking about financial independence and the math of never running out of money. If you're someone who has started investing but has no idea how much you actually need to retire, or you've heard the term 4% rule and nodded along without really knowing what it means, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Section 1, where the 4% rule comes from. Let's start at the beginning, because the origin of this rule matters. The 4% rule didn't come from a financial influencer or a motivational book. It came from serious academic research. In 1994, a financial advisor named William Bengen published a paper in the Journal of Financial Planning that would quietly change retirement planning forever. Bengen asked a deceptively simple question: how much can a retiree withdraw from portfolio each year without running out of money over a 30-year retirement? He backtested this question against historical market data, going all the way back to 1926. Through every major crash, the Great Depression, Black Monday, the oil crisis, all of it. And what he found was striking. A portfolio invested in a mix of stocks and bonds could sustain an annual withdrawal of 4% of the initial balance, adjusted for inflation each year, without running out of money over any 30-year period in the historical record. 4%. Not 3. Not 5. 4. That was a floor. The worst-case historical scenario still survived a 4% withdrawal rate. This was later expanded and validated by what's known as the Trinity Study, a 1998 paper by 3 professors at Trinity University, which tested the same question across different portfolio allocations and time horizons and largely confirmed Bengen's finding. A 4% withdrawal rate from a portfolio of roughly 50% to 75% stocks had a success rate of around 95% over 30-year periods based on historical data. Here's what most people don't realize. This isn't a rule of thumb someone made up. It's one of the most thoroughly backtested findings in personal finance. That doesn't make it perfect, and we'll get to the criticisms. But it's not arbitrary. Section 2, the math, your personal number. Okay, this is where it gets really interesting. Because once you understand the 4% rule, calculating your personal financial independence number becomes almost embarrassingly simple. The formula is this: take your annual expenses and multiply by 25. That's it. That's your number. Why 25? Because if you have 25 times your annual expenses invested, withdrawing 4% of that each year gives you exactly your annual expenses. It's just math. 4% times 25 equals 100%. Let me make this concrete. Say your annual living expenses are $40,000. Your financial independence number is $40,000 times 25, which is $1 million. If you have $1 million invested in a diversified portfolio, you can withdraw $40,000 per year, adjusted upward for inflation annually, and historically that portfolio lasts 30 years with very high probability, and in many historical scenarios, actually grows over that period. Now, let's run this at different expense levels, because I want you to see how dramatically your target changes based on how you live. Annual expenses of $30,000. Target portfolio, $750,000. Annual expenses of $50,000. Target portfolio, $1.25 million. Annual expenses of $80,000. Target portfolio, $2 million. Annual expenses of $100,000. Target portfolio, $2.5 million. Notice what this tells you. The single most powerful lever in your financial independence timeline is not your investment returns. It's your expenses. Every dollar you permanently remove from your annual spending reduces your financial independence target by $25. If you cut your lifestyle by $10,000 a year, your target drops by $250,000. That is enormous. Now, you might be thinking, John, $1 million sound impossible. And I understand that instinct. But let's look at the timeline, because this is where compound growth does something almost counterintuitive. If you're 30 years old and invest $1,000 a month into a broad index fund earning a historical average of 8% annually, you'll hit approximately $1.7 million by age 60. 30 years, $1,000 a month. That's a financial independence number that covers $68,000 in annual expenses indefinitely. And if you push that to $1,500 a month, which for a lot of people is achievable with intentional budgeting, you're looking at roughly $2.5 million. That's financial independence at a $100,000 annual spending level, reached in 30 years, by someone who just consistently invested $1,500 a month starting at 30. Section 3. The criticisms of the 4% rule, and are they valid? Here's the thing. The 4% rule is not without its critics, and I'd be doing you a disservice if I didn't walk through the legitimate concerns, because some of them are real. Criticism number 1. The rule was designed for a 30-year retirement. If you're planning to retire at 40, you might need your portfolio to last 50 or 60 years. The original research doesn't guarantee success over that longer horizon. Some financial researchers suggest dropping to a 3% or 3.5% withdrawal rate for very early retirees to build in more margin. Criticism number 2. The historical data is heavily weighted toward the U.S. market, which had extraordinary performance through the 20th century. Some researchers argue that future returns may be more modest due to lower dividend yields, higher starting valuations, and demographic shifts, and that the rule might be too optimistic for portfolios going forward. Financial researcher Wade Pfau has published work suggesting a more conservative rate of 3% to 3.5% may be more appropriate given current market conditions. Criticism number 3. Sequence of returns risk. This is probably the most important technical concern. The 4% rule works on average, but the order in which returns happen matters enormously. If you retire right before a major market crash and start withdrawing while your portfolio is down 30% or 40%, you permanently impair your portfolio's ability to recover. This is called a bad sequence of returns, and it's the primary way the 4% rule can fail in practice. Now, are these criticisms valid? Yes, partially. But here's what most people don't realize. The original research already stress-tested against some of the worst market periods in American history, including the Great Depression, and the success rate still held around 95% at 4%. The criticisms are worth taking seriously for planning purposes, but they don't invalidate the rule. They refine it. My practical take. If you're planning a retirement of 30 years or less, 4% is a well-supported starting point. If you're planning for 40 or more years, which describes most people pursuing early financial independence, use 3.5% as your planning rate. That means your multiplier goes from 25x to roughly 28x your annual expenses. A slightly higher target, but one that gives you much more margin. Section 4. How to actually build to your number. Understanding the 4% rule is one thing. Building toward your number is another. So, let me give you the practical framework. Step 1. Calculate your annual expenses honestly. Not what you think you spend, what you actually spend. Pull your last 12 months of transactions and add it up. Include everything: housing, food, transportation, insurance, healthcare, entertainment, subscriptions. This is your baseline. Step 2. Multiply by 25 or 28 if you're targeting early retirement. Write that number down. That is your target, not a vague aspiration, an actual specific number. Step 3. Calculate your savings rate. Your savings rate, the percentage of your income you actually save and invest, is the single biggest determinant of how quickly you reach your number. There's a well-known table in the FIRE community that shows retirement timelines by savings rate. At a 10% savings rate, you're looking at roughly 40 years to financial independence. At 25%, about 32 years. At 50%, around 17 years. At 65%, approximately 10 years. The relationship is not linear. Every additional percentage point of savings rate has an outsized impact, especially as you get higher. Step 4. Invest in low-cost, broadly diversified index funds. The 4% rule was built on stock and bond market returns. You need to actually be in the market for those returns to apply to you. High-fee actively managed funds eat into returns in ways that can meaningfully shift your timeline. A fund with a 1% annual expense ratio versus a 0.04% index fund might seem like a small difference, but over 30 years on a $500,000 portfolio, that 1% difference in fees costs you roughly $150,000 in foregone growth. Step 5. Protect against sequence of returns risk. As you approach your financial independence number, shift a portion of your portfolio, typically 1 to 3 years of living expenses, into something stable and accessible, short-term bonds, cash equivalents, a high-yield savings account. This is your buffer. If the market crashes 40% in your first year of retirement, you draw from this buffer instead of selling equities at a loss. You give your portfolio time to recover. This single strategy dramatically improves the real-world survivability of the 4% withdrawal rate. Section 5. The psychology of the number. Here's something I think about a lot. The 4% rule isn't just a math formula. It's a psychological framework. And understanding it changes the way you see every financial decision you make. When you understand that every dollar of annual spending requires $25 in invested assets to sustain indefinitely, the question, should I spend this, takes on a completely different weight. That $200 monthly subscription isn't $200. It's $2,400 a year, which means it requires $60,000 in invested assets to sustain forever. Does it bring you $60,000 worth of value? That reframe is powerful. On the flip side, every raise you don't inflate your lifestyle to match is double leverage. It increases your invested assets and reduces your required target simultaneously. A $10,000 raise that you fully invest adds to your portfolio, and because you're not increasing your expenses, doesn't change your financial independence number. That's the compounding magic of keeping your lifestyle flat while your income grows. This is where it gets really interesting psychologically. Most people think about financial independence as an abstract destination that's either impossibly far away or not particularly relevant to them. But the 4% rule makes it concrete. It gives you a number. And having a specific, achievable number, even if it's a decade or more away, transforms your relationship with every financial decision you make today. Section 6. The partial financial independence insight. I want to leave you with something that most financial independence content doesn't discuss enough. You don't have to hit your full number to dramatically change your life. Think about what partial financial independence looks like. Say your full financial independence number is $1.5 million, but you build a portfolio of $500,000, a third of the way there. At 4%, that portfolio generates $20,000 a year in sustainable withdrawals. That's $1,667 a month. Now, maybe that doesn't cover your full expenses, but it changes the calculus of your life completely. You don't need your job to pay you $80,000 a year anymore. You need it to pay you $60,000 because your portfolio is covering the other $20,000. You could work part-time. You could take a lower-paying job you actually enjoy. You could take a year off without financial catastrophe. You have options. The concept here is what the FIRE community calls a Coast FI number, the point at which you've invested enough that, even if you stop contributing entirely, compound growth will carry your portfolio to your full financial independence number by a traditional retirement age. For a 35-year-old targeting $1.5 million at age 65, the Coast FI number is roughly $370,000. Once you hit $370,000 invested at 35, you theoretically don't have to invest another dollar, and you'll still reach $1.5 million by 65 at 8% average annual growth. That's not full financial independence, but it's freedom from the pressure to save aggressively. It's optionality. It's leverage. And for a lot of people, it's a far more achievable and motivating near-term target than the full number. Closing. So here's where we land. The 4% rule is a research-backed framework that says if you have 25 times your annual expenses invested in a diversified portfolio, you can withdraw 4% of that amount each year, adjusted for inflation, with historically very high confidence that your money will last 30 years or more. Your number is your annual expenses times 25. Write it down right now after this video. That number is your target. Every dollar you save reduces that target. Every percentage point you increase your savings rate shortens your timeline. Every unnecessary expense you cut is $25 less you need to accumulate. And every year you invest consistently, compound growth is doing work you don't have to. Look, financial independence is not a fantasy for other people. It is a math problem with a formula. And now you know the formula. If this video gave you clarity on what you're actually working toward, hit the thumbs up. It genuinely helps this content reach the people who need it. Subscribe if you're not already. And drop in the comments, what's your financial independence number? Do the math right now and post it. I read every single one. The finish line is a number. Now you know how to find yours. I'll see you in the next one.